Everyone has an opinion about investing. Some people swear by premium bonds, others chase crypto, and there's always someone convinced they can pick the next big stock. But what actually works? Today I'm ranking the most popular investment strategies from S tier all the way down to D tier, based on long-term wealth building. And trust me, some of these might not land where you expect. Let's start. I'm ranking these based on four things: long-term growth, diversification, simplicity, and how likely they are to help the average person build real wealth. This isn't about hype, it's about results. Premium bonds are extremely popular in the UK. Your money is safe. Your money is safe. You get monthly prize draws, and there's always that tiny chance of a big win. But here's the reality. Most people earn less than they would in normal savings or investments, and inflation slowly eats away at returns. They're great for short-term cash or emergency savings, but for long-term investing, they're slow. Premium bonds go into C tier. Dividend investing feels great. Seeing money hit your account makes investing feel real. And for income-focused investors, dividends absolutely have a place. But dividend-heavy portfolios often grow slower than broad growth-focused funds. You're trading some future growth for income today. Dividends sit in B tier. Robo-advisors are investing on autopilot. You answer a few questions, pick a risk level, and the platform handles everything. That simplicity is great for beginners, but fees can quietly add up over time. And many portfolios are just ETFs you could buy yourself for less. Robo-advisors go into C tier. Target retirement funds are designed to adjust automatically as you get older. More growth when you're young, more safety as retirement approaches. For people who want zero hassle, this works really well. The downside is less control. Target retirement funds sit in B tier. Life strategy funds are another set and forget option. You choose a stock to bond ratio, and the fund keeps it balanced, simple, diversified, beginner friendly. The downside is limited customization. Life strategy funds go into B tier. Crypto is exciting, huge gains, massive headlines, lots of hype. But from an investing perspective, there's no earnings, no cash flow, and extreme volatility. That makes it speculation, not a foundation. Crypto goes into D tier. Gold is often called a safe haven. And yes, it can add stability during uncertain times, but it doesn't grow like a business. It doesn't pay income. You're relying purely on price movement. Gold sits in C tier. Stock picking sounds exciting. But the reality is that most individual stocks underperform the market. Only a small number drive most long-term returns. Unless you love research and constant monitoring, the odds are stacked against you. Stock picking goes into D tier. Now we're getting into the stronger options. The S&P 500 gives you one fund with 500 major US companies. Low fees, strong historical performance, extremely simple. The downside is heavy US concentration. Still, it earns a tier. Developed world funds expand beyond just the US. You get exposure to Europe, Japan, and other major economies. More diversification while keeping things simple. Developed world funds also land in A tier. Now we reach S tier. The FT's All World gives you global exposure in one fund. Developed markets. Emerging markets, thousands of companies, no guessing. You simply own the world economy. FTS tier. Global All Cap takes this one step further by including smaller companies as well. Maximum diversification. You're not betting on one country or one sector. You're betting on global growth itself. Global All Cap also sits in S tier. Here's the truth. The more complicated investing feels, the more likely people are to mess it up. The strategies that look boring are usually the ones that work best over time. So the goal isn't to be clever, it's to be consistent. Invest simply, stay invested, and let time do the heavy lifting. Thanks for watching, and I'll see you in the next one.